Welcome to FatCity Finance. Today we've got a list of the 10 highest dividend yield ETFs. These exchange-traded funds have been making waves in the investment world, offering unparalleled potential for high returns. They're the financial instruments that could be the game changers in your investment portfolio, providing a steady stream of income while diversifying your holdings. But before we dive into this fascinating subject, please take a moment to hit that like button, subscribe, and ring the bell for all the latest updates. It really helps our channel grow. Kicking off our list, we have the Simplified Tail Risk Strategy ETF, or CYA, with an impressive dividend yield of 112.86%. This ETF is known for its strategy of providing portfolio protection in the event of a significant market downturn. It uses a mix of treasury bonds and long-dated options on the S&P 500 to achieve this. The high yield is mainly due to the income generated from selling these options. Despite its unconventional approach, it has proven to be quite profitable, making it a strong contender for those seeking high returns. Next up is the Yield Max TSLA Option Income Strategy ETF, otherwise known as TSLI. This ETF has a dividend yield of 73.61%. TSLE's strategy is a bit different. It focuses on generating income by selling covered call options on Tesla Inc. shares. This means that they sell the right for someone else to buy Tesla shares at a certain price within a specified time frame. If Tesla's stock price stays below the strike price, the ETF keeps the premium from selling the call option, resulting in high income and therefore a high dividend yield. Our third ETF is the CraneShares China Internet and Covered Call ETF, symbol KLIP. This ETF offers a dividend yield of 63.28%. KLIP invests in a basket of Chinese internet companies while also selling covered call options on the same holdings. The idea here is to generate additional income from the option premiums, which are then passed on to investors as dividends. This strategy can be particularly profitable when the Chinese internet sector is stable or slightly declining, as the ETF can still generate income from the option premiums. These three ETFs, CYA, TSLE, and CLIP, provide substantial returns, making them attractive for income-focused investors. They each have their unique strategies and performances, but what they have in common is their ability to generate income in various market conditions. Investing in them could provide a significant boost to your portfolio's income generation. Moving right along, we have GraniteShares 1.25x Long Tesla Daily ETF, often referred to as TSL, with a yield of 59.02%. This ETF offers investors a unique approach to investing in Tesla, one of the most innovative and controversial companies in recent times. It uses leverage to amplify the daily performance of Tesla, providing high potential returns. However, keep in mind that with high reward comes high risk, so this might not be the best fit for the risk-averse. Next up is the Invesco CEF Income Composite ETF, or PCEF. It has a yield of 13.23%. PCEF offers investors exposure to a diversified portfolio of closed-end funds, hence the CEF in its name. These funds are primarily invested in income-producing securities, making PCEF a great choice for income-focused investors. It's worth noting that this ETF has a solid track record of performance, offering both capital appreciation and regular income. Last but not least in this segment is the Global X Super Dividend Alternatives ETF, also known as ALTY. With a yield of 12.76%, this ETF is a standout. ALTY offers exposure to a variety of alternative income strategies, including real estate, infrastructure, and MLPs, which stands for Master Limited Partnerships. These sectors are known for their high yield potential, making ALTY an excellent option for those seeking to boost their income. It's important to note that while these ETFs offer high yields, they also come with their own set of risks and considerations. For instance, TSL's strategy is tied to the performance of a single company, which can be risky. PCEF's closed-end fund investments can sometimes trade at a discount to their net asset value, which could affect returns. And ALTY's exposure to alternative income strategies may not be suitable for all investors. In conclusion, these ETFs not only provide high yields but also offer diversification benefits. They serve as excellent tools for income generation and can add considerable value to your portfolio if used wisely. Next up, we have the VanEck Mortgage REIT Income ETF, otherwise known as MORT, boasting a yield of 12.3%. MORT is a unique offering in the ETF sphere, as it focuses on mortgage real estate investment trusts, or REITs. These trusts are companies that own, operate, or finance income-generating real estate. Mort's strategy is to replicate, as closely as possible, the price and yield performance of the MVIS U.S. Mortgage REITs index. This index tracks the overall performance of publicly traded mortgage REITs in the United States. With its high yield, MORT offers investors an attractive income potential, coupled with the possibility of capital appreciation. But what makes Mort stand out? Well, it's the high level of specialization. Focusing solely on mortgage REITs gives this ETF a unique risk-reward profile, making it an interesting option for investors seeking diversification. Just remember, with every investment, there's always some degree of risk involved. So it's essential to do your homework before diving in. Moving on, we have the Global X Super Dividend ETF, or SDIV, with a yield of 11%. Now, if you're looking for global exposure, SDIV could be a perfect match. It follows the Selective Global Super Dividend Index, which tracks the performance of 100 equally weighted companies that rank among the highest dividend-yielding equity securities globally. SDIV's investment strategy is to invest at least 80% of its total assets in the securities of the underlying index. This means you get exposure to a broad range of global companies across various sectors, known for their high dividend yields. It's a great way to diversify your portfolio and potentially boost your income. In a nutshell, both MORT and SDIV offer interesting opportunities for investors seeking high dividends. MORT's focus on mortgage REITs provides a unique angle, while SDIV's global reach could help diversify your portfolio. These two ETFs are great for those seeking a steady income stream from their investments. Rounding up our list, we have FCF International Quality ETF, also known as TII, with a striking dividend yield of 10.38%. This ETF has carved a niche for itself in the world of finance with its focus on international markets. TII is designed to track the performance of high-quality, large and mid-cap equities across developed and emerging markets outside the United States. It's a great way to diversify your portfolio while also enjoying a respectable dividend yield. TII's strategy is focused on quality, and it identifies companies with strong fundamentals such as stable earnings, solid management, and the ability to generate substantial cash flow. It's these qualities that have allowed TII to consistently deliver high dividends to its investors. So if you're looking for an ETF that provides exposure to international markets and prioritizes quality, TII might just be the right pick for you. Last but certainly not least, we have Analyte Capital Management Inc., or NLY, with a dividend yield of 10.4%. NLY is a mortgage REIT that owns, manages, and finances a portfolio of real estate-related investments, including mortgage pass-through certificates, collateralized mortgage obligations, and other securities. Its primary business objective is to generate net income for distribution to its shareholders through regular quarterly dividends. NLY's strategy involves a careful balance of risk and reward. By focusing on high-quality income-producing assets, NLY has been able to maintain a high dividend yield. It's a strategy that has served them well, and it could serve your portfolio well too. Remember, it's important to do your own research and consult with a financial advisor before making any investment decisions. But if you're seeking high dividends and are willing to venture into international markets or real estate, these two ETFs might be worth considering. These ETFs are perfect for those who want to gain exposure to international markets while earning high dividends. So there you have it, the top 10 high dividend yield ETFs. From the electrifying Simplified Tail Risk Strategy ETF with its staggering yield of over 100% to the more modest but still impressive Analyte Capital Management Inc., offering a solid 10.4% return. In between, we've seen an array of diverse options. The Yield Max TSLA Option Income Strategy ETF and the Granite Shares Long Tesla Daily ETF demonstrate the power of tech-focused investments. Meanwhile, the Crane Shares China Internet and Covered ETF reminds us of the opportunities in international markets. The Invesco CEF Income Composite ETF and the Global X Super Dividend Alternatives ETF both offer double-digit returns, while the VanEck Mortgage REIT Income ETF and the Global X Super Dividend ETF illustrate the potential of real estate-focused funds. Lastly, the FCF International Quality ETF shows us the value of a well-rounded, quality-focused investment strategy. Remember, these high dividend yield ETFs can be a valuable addition to your portfolio, providing both diversification, and a steady income stream. But as with any investment, it's crucial to do your research, understand the risks, and consider your personal financial goals before jumping in. Don't forget to like, subscribe, and ring the bell for the latest updates. Thanks for watching, and as always, happy investing.